morning, ladies and gentlemen, boys and girls. Welcome along to the latest A.R.D. Consultancy webinar for February with me, Andrew Dawkins, and
myself, Rachel Blackhall.
Lovely to see you again.
Thank you all for joining us again. So our agenda for today is, I'll touch on briefly what's currently happening at A.R.D. Consultancy. We will then move on to describe a little bit more about what's involved in building an A.R.D. Consultancy Fund Portfolio.
Ooh.
Then we will look at the performance analysis for these portfolio funds, moving on to a brief market update from Andrew, and then round off with any questions and answers.
Great. So first of all,
what is currently happening at A.R.D. Consultancy? Well, it doesn't feel like all that long ago since our last webinar, so there's not really a great deal of change that I can report on. Updates, I would say, are that the old mutual wealth system is now undergoing its upgrade and migration to a new platform. So that's likely to be down for just another week or so, hopefully back up and running.
Nothing anybody needs to do at the moment, though, is there?
No, nothing at all. It's just stopping us at our end a little bit, and then we'll go on to the new platform and then be transacting business as usual on a new and improved system. We also have tax year end fast approaching. So we're doing some reports and things at our end, just making sure that people who possibly still have ISA allowances that are unused, making sure that we're making use of those. Anybody else who has anything that they want to do, any changes they want to make, please just give us a call because it will be here before we know it. The only other point I think to make this month is that while we're doing a lot of admin housekeeping here for the tax year end approaching, we're assured that a lot of people are doing the same at home, organising the paperwork and things that they accumulate over time. So we just thought it'd be worthwhile saying that anybody who has updated, say, passports, driving licenses, ID documents, or even changed bank accounts, if you can just let us know of any changes at year end, and we will make sure that our records are up to date. One of the benefits of this is that we can upload copies of identification documents to your client website, so that if you're ever out and about and need it for whatever reason, you would be able to access it on your phone or laptop, or if you have any of those devices with you. And I think that's about all from me. There's not much more to report on in the office, I don't think. Andrew, is there anything?
Well, I think the only other thing is that we're getting really good at making some really decent coffee.
Oh, yes, that's true.
I've been very impressed with my coffee skills. So I think on the old website, I think I had a score of 0 out of 5 for coffee making, but I think now it's going to be touching 2. Not even 2.5.
Proper barista now.
Thank you very much. I'm sure that's not an insult.
And so, right, let's take a look at what's involved in building an A.R.D. Consultancy Fund Portfolio. So we'll try not and get too technical or boring here, keep it light, and just explain a little bit about the process that we have here.
Yes, I think that's a good idea, because we don't want to get too technical with any of the webinars that we run, because the idea is to try and simplify things as much as we can. So if we start off by looking at the portfolios that we build. Now, a number of our clients will be familiar with the portfolios, and some of our clients use individual funds, which are slightly different from portfolios. But I think about 75% of our clients are familiar with the portfolio, so we thought we would run through the portfolio, because the same principles apply to a lot of the investment funds that we select for clients.
Yes, exactly. So here at A.R.D, we run or create 5 model portfolios, which each of them require a different investment solution, going through the range of attitude to risk, starting off at defensive, moving up slightly to cautious, balanced, capital growth, and aggressive. I think it's worth noting these are just portfolio names, and probably wouldn't read too much into the defensive or aggressive wording, because it really all does come down to sort of personal attitude to risk, and what one person may think is defensive, another may not, and likewise with aggressive. It's not to say that because you're an aggressive portfolio that everything's at risk and you could lose all of your money. It's not that at all. These are just portfolio names.
Yeah, and we're open to suggestions. So if anybody's got any ideas, please let us know.
Okay, so first of all, we start the journey with a blank piece of paper and then begin to scratch our heads.
Oh.
So yeah, we'd start this process from scratch every time that we look. We don't get complacent and just stick with the same portfolios and tweak those ever so slightly. We start with a blank piece of paper each and every time that we meet and build them from the ground up, really. So although we obviously work together in the office, we do set aside time regularly to meet and just discuss the world of investment funds and solutions and just focus solely on creating these portfolios.
Yes, I think the meetings are very useful because there may be events that happen that we'll want to be reflecting within the portfolios. We used to have at least 2 regular updates to the portfolios when I think the world was a little bit more precarious, and we moved over a number of years ago to just have 1 major investment review a year, unless anything significant happened in the interim. So generally, it's we're looking at the portfolios every day of the week, but then we'll make decisive decisions at least now annually.
Yes, exactly. We don't like to be making changes just for the sake of it, and we don't obviously make any knee-jerk reactions to anything that is going on in the world. So we'll obviously keep all of these under hats and keep it into consideration for decisions that we make. And although we do at least annually, we may well make a change in between times if we feel it's necessary. So we never get complacent.
Now, to help us in the process, we use a variety of tools, and probably the one we start off with is a company called Morningstar, and they're a research firm. They're an American company which carries its own challenges because some of the suggestions they have are more suited perhaps to the American market than here in the UK. But they will give us an angle as to where they see the next 3 to 5 years in terms of allocation rates. So they'll give us a view on where in the world we should be looking to invest, and indeed what assets we should invest in, and then we'll use that as the basis for going forward. So, for example, Morningstar may say that for our middle of the road or balanced portfolio, perhaps in their view, we should have 15% holding in North American shares. So we'll say that, right? Okay, let's have a look at that, and we'll start that as the point to which we go forward. There are though challenges.
Indeed, yes. So, like you're saying, for example, we will look at where they suggest allocating these portion of the investment funds. It could be all around the world, but one of the challenges we sometimes have is that their suggestion could be to allocate a portion to, say, emerging markets debts, for example. We've personally found this in the past. It's a difficult area to find a good fund that meets the criteria and adds value. This is where it's key. So we will look into the areas that they suggest, but if we don't feel there is a suitable fund for our clients that we feel is worthwhile adding to the portfolio because we can see where they can add value, we won't do it just for the sake of it. We'll perhaps look at other areas of the world to allocate instead.
Yes. So what we do is take a view, and the view we take is not over the next few months or even the next 2 or 3 years. It's longer term than that. It's over the next 5 to 10 years. So often we're asked, well, what account of things like Brexit, presidential elections, even just at the moment, COVID, what effect does this have on our planning? And generally, it has no effect at all because of the fact that we're ignoring the short-term movements. If something presented itself that looked like it was going to change the world forever, so for example, one of the things that may well happen going forward is in terms of property. Perhaps there may be less demand for high premium, large office accommodations in cities, not only in the UK, but worldwide, as more people may work from home. So it could be then we take that's a fundamental change that's happened just now. So we must say, okay, let's have a look at property, and perhaps we don't want as much office space in the portfolio as we did before. So we find that when we take the longer term view, and it's about asset allocation, so where we should have money invested, actually asset allocation can be more successful than individual fund selection. So many studies will show that if you allocate correctly, it doesn't matter so much which fund you actually choose. Once you've got your allocation rates, then the performance will speak for itself.
Some of the allocation rates that we allocate to the different portfolios, we've got fixed interest, which we have discussed before, which is another word for debt, and that will include both company debt and government debt. Property, as Andrew mentioned, that's more the commercial side of things. And the equities, UK equity, it'll include large and small companies, European equity, North American equity, emerging markets, Far East, cash and commodities. So there's quite a lot of diversification there and spread across the world.
Yeah. And we will then use our own investment skills, which are limited.
Oh, I think the charts speak differently, Andrew.
Oh, too modest. And we then look at what funds we have to choose from here in the UK. So all our funds that are available are all UK listed. And this gives us over 3,000 different investment funds to consider for inclusion within the portfolio.
Yeah, so there's quite a few requirements and criteria that we set for things that we will look for when we're researching all 3,000 of those funds that Andrew just mentioned. One thing is straight away we'll rule out any single mixed funds. So we're looking for funds that do fit the allocation rates that we have. So in other words, if we are choosing a European equity fund, we want that fund to only hold European quoted equities and not include other overseas companies and holdings and things. Quite often you will find that you'll get a single fund which incorporates a lot of different things within it. So it's looking under the bonnet and seeing exactly what these companies are investing in, what companies they're buying, their shares and things. And we make sure that they are focused solely on FSA European at this time.
The next thing we look at is a track record. So ideally we want a fund to have at least 5 years past performance for us to be able to consider. And we do this because of the fact that there's a number of funds that launch, and they launch very successfully, and they do great things in the first 1 to 3 years or so. And they can achieve this because of the fact the fund manager gets a relatively small amount perhaps at outset to manage, and they can do this perhaps quite easily. So they're predicting, say, we'll raise 10 million, they raise that 10 million, and then they work out how they can invest it. If suddenly they appear at the top of the chart, so the performance period for a year or a few months, they'll get a lot more money coming to it, because a lot of people, unfortunately, the herd mentality, they go, oh, I must be with the top performing fund in its sector, I'm going to go into this fund. And the fund manager then sometimes, as we've seen from history, then is awash with cash, and they may be okay at investing 10 million, but when it comes to investing 100 million, 150, etc., they fall to bits. And you do see funds that go yo-yo. They go up 1 year, and the next year they drop because of the significant amounts of cash they've had there. And then when the performance starts to slip, they get withdrawals, money taken out of them, and away we go again. So we want a fund that performs well over the 5-year period, and not just a flash in the pan. They might have got it right at the beginning, but perhaps longer term, that's where we want them to be able to show a consistent record.
Absolutely. Mentioned it already, but the funds that we're looking for, they must add value. So we're looking for something that's doing better than many others out there, or at least an index. So for example, if we're selecting a UK equity fund, we'll want it to provide the potential for superior returns over the FTSE All-Share Index over most time periods. Obviously, things happen, and we can't always guarantee that a fund's going to perform or outperform an index every day of the year for years and years and years. So we're looking back, but we want something that's consistently outperforming an index, doing better than the index that's out there at the moment. That's where we see the potential for our clients to make money.
We then research the fund provider who we've seen one of their funds perhaps that we'd like to use, and we want to then get to know the fund manager and what their investment style is and philosophy. And we will then, if we can, speak to the fund manager on behalf of our clients to find out what their views are on the market. And at that stage, it's a big telling point, because we may discover that their views perhaps don't align closely with ours, and therefore we may say, well, thank you, but no thanks.
Yeah, exactly.
On the other hand, we may get a fund manager that surprises us with one or two bits of information, perhaps that may contradict what we're saying or experiencing, and we'll say, well, actually, that view is valid, and we by no means say, well, just because we don't agree with you, we're not going to use you. There may be a reason why we can go, well, actually, we can have you in our portfolio, perhaps not for the share of asset allocation we were initially thinking, but perhaps a smaller share, just to see how we go.
Yeah, I think it's worthwhile noting that, so it's not just all about the analytical information, it is about the personal side as well. I think any computer program could scan the market for funds that, like I say, outperform over such and such time period, but actually speaking to the team that run the funds and getting their views and things, that really adds value, and that's where we see the great benefit. And sometimes, like Andrew said, they may tell us something that we weren't expecting, change our views or cement our views.
And one of the funds we use, our North American fund, tends to be an index tracker, which is difficult because it's a computer model. So it's difficult speaking to the computer. We don't tend to get much sense out of it. But on the other hand, it's probably gets more sense out than some of the fund managers we speak to. We also tend to avoid star investment managers. So people, we don't see as many of them on the TV these days, but it used to be years ago, there was 2 or 3 individuals that would get their high names, star performers, etc. And the difficulty with this is, okay, they may shoot the lights out 1 month and may do particularly well over a period of time. But if it's down to one individual, it causes a bit of a challenge, because that one person's knowledge is pivotal to their success. Well, what happens if they go on an extended holiday, or they have an illness, or decide to call it a day or move elsewhere? Then you've got a challenge. So what we're wanting is a good team, and we're wanting a methodology to the way that they select the particular assets for inclusion. So we're wanting not a star. We prefer the team.
Yeah, approach. Not beholden to one person, and hopefully. Yeah. So next point to note is past performance. So obviously this is an important one, and it is part of the criteria that we look for inclusion. It's good to look back and see how these funds have performed over particularly volatile time periods. For example, COVID. There's been various events in the past, and it's been good to see how these funds fared compared to various competitors. What we like looking for is reduced volatility. So we don't like funds that boom 1 year and then go bust the next. We much prefer funds that will return superior to average, but they achieve that consistently. So we found that over time, narrowing down this search really does help reduce the risk, but we found that it increases long-term returns. Like I say, the boom and bust is not something that we're looking for. We're looking for more consistent, because we're looking for long-term returns. And over long duration, then these are the types of funds that climb and climb.
Oh,
there we go. Get this picture here, Andrew.
That's my mum in the middle, I think, there. Thank goodness we can't hear her. That's
hope she's not listening.
We just see there we've lost a viewer.
So once we've selected the funds that are going to make the portfolios, or so we think, then we'll look at how they all work collectively within the portfolios, just to ensure then that they match the level of risk for each of the 5 styles that we are trying to create here. And we'll then adjust if we feel that they don't complement each other or don't work well together. Sometimes at this stage, we can find, for example, that after analysing the funds, we might have too much exposure to cash. Each fund tends to hold an element of cash to be able to enable them to to buy the shares that they need to do at whenever they see that moment. But that can also dilute the portfolios, and we don't like holding too much cash in, say, the higher risk portfolios. So we'll adjust that if we feel the need.
One recent example of that is, again, going back to the commercial property fund. Some of the funds there are holding almost like 40% in cash. Well, that's not a property investment, that's a cash fund with a little bit of property tagged on the side. So that's what we try and avoid. And then we'll need to perhaps tinker around the allocation rates when we get the overall composition of the portfolio in place.
So also, while we're creating the portfolios, there are times where we're just reviewing them. And like Andrew said, we'll look at these portfolios daily. So there's perhaps times where we may have one or two questions to ask the fund managers about their own holdings. So if we're looking to perhaps replace or just get some further information on one of the funds and why their performance may have changed, we'll speak to the managers and gauge their thoughts as to why their fund may have suffered, or have they made any changes to their objectives or their asset class in an attempt to try and turn things around. So once again, we don't make any short, sharp decisions without looking into it and without speaking to the company themselves and get their views on it. We'll take into account their opinions and then make a decision as to whether we feel that a fund should be replaced or perhaps just given a second chance if we can understand a change they may have made at their end and we can see how that will turn things around. So it's just really to let you know that this is something that we do regularly. We speak to the fund managers and see what their views are, because we do want each of the funds to stand on their own feet, although they're part of a portfolio. That doesn't mean that we just let them go. So if there's anything in particular that we want to look at, we want the funds to be doing well individually as well as contributing to the portfolio. So nobody gets any special favours.
And then
here we go.
What the heck is this?
Yeah, so this is all the methods of contact, I believe, that are out there at the moment. So wow. You may know that we've recently made some changes to the portfolios. Now, what we can't do is just go ahead and make these changes without letting our clients know. So
what we could do.
Well, we could, but would be going against their obligations. So the problem we have is that many of our clients just say, oh, but that's what we pay you for. That's what we're expecting you to do. Yeah, if that's your advice, change it. And whilst it is our advice, we still have to get your approval. So we have to make sure our clients understand what changes we're making or suggesting and why, the reasons behind those. So we do need to communicate this to all of our clients and get your approval to do so.
Some people do take an active interest in the way we look after the money, which is great. We really love that. And there's some people that couldn't care less. That's fine.
Yeah, that's it, exactly.
Yeah. So it's equally, we love having discussions with people about the makeup of the fund, or what constitutes a good fund, why we're making the changes, and those conversations are great. And equally, we love speaking to clients who really just say, get on with it and make me some money, and that's the way they leave it. So,
well, I think that's why we're doing this webinar today about the portfolio construction, because it has raised a lot of questions and discussions. People who are looking to just learn a little bit more about why we're making these changes and how we create the portfolio. So yeah, we thought we'd just touch on that with a little bit, well, hopefully not too dry, some information on how we do it here. So obviously it's not too in-depth today, but if there is any questions at all or anything else that you want us to cover, then please let us know. We're happy to answer any questions.
Well, I think we're going to run a video just now, but while the video is playing, if you have any questions, please type them in as we're going along. And then once the video's finished, we'll come back and we'll do the market update. But it's probably a good time if there are any questions, type away, and we'll play a wee video now.
Play it now, and I think you may just need to check that you have your volume setting on for this.
Our volume or at home?
At home.
Right. Turn your volume on now. Okay, welcome back, and hope you had a cup of tea while that was on.
Still awake?
Yes, I am.
Just as well. It's over to you now. So, what's your views on the market? Any updates to report on?
Yeah, well, in terms of this month, then I think the story is as it has been for the last 2 or 3 months since October, when the vaccines were proven to be successful. So, in terms of the US, then it's for the first time in quite a long time actually that we see within our portfolios we've got 2 US companies in the top 10 of our holdings, and this is Microsoft and Apple. Probably because of the stellar returns that they had over the last year on their share price. So Apple up almost 60% and Microsoft over 45%. So they've now weighed into the top 10 holding. And it's funny, when we were looking at the top 10 each day, it's funny the amount of companies that are going up and going down. And
it's changing, yeah. So we also touched on this in previous webinars and discussed the current top 10 at that time. But it's changing almost weekly at the moment.
Yeah, so the actual US fund this month that we use, the funds that we use, then they're up over the month period, month to date anyway, and the Americans still the top fund over 5 and 10 years. I think the chair of the Fed this week was making comforting noises to the market, saying that they're going to continue with the pumping money into the market and supporting the money supply. And they were also saying that they still want to get unemployment levels down, so that will help to put money in. The stimulus package is still yet to be rolled out, so the signs there that there is growth will be coming if it's not there already, and inflation apparently is not so much of an issue with the Fed at this moment in time. The UK market,
yeah, UK is doing very well. We looked this morning, and year to date, the pound is the best performing major currency, the 16 worldwide currencies.
Which is great news if you're going overseas on holiday.
Yeah, exactly. The UK markets, again, doing exceptionally well. The FTSE 100 is one of the best performing stock markets out there. It's up 6.4% in the last year. The US is up 4.6% and Europe 4.3%. So, yeah, good news for the UK.
I think it really comes on a couple of things. It's the Brexit premium that we're getting a lot of money now coming into the UK, whereas for the last 4 years or so, the money's been on the sidelines waiting to see what the Brexit deal actually ends up looking like. So now people have got confidence, they know exactly where it's going and where it's leading. Then the money's coming back in, and the UK is well placed because of its COVID inoculations, and it's going to see that the UK oil and mine sectors have done particularly well. And I was speaking to one of my idols earlier in the week, and they
here we go again. I've heard it all week.
Okay.
Andrew was a bit starstruck.
Anyway, moving on. So there are people out there that think oil is going to hit $100 per barrel by year end, and we've got a bit of a challenge coming down the line with supply and demand. That at the moment, with most airlines not flying as much as they used to be doing, by the time we get people up in the air again, there could be a shortage of not only aviation fuel but oil generally. So a big squeeze on that, which is causing the share price of Shell and BP, who we hold both stocks, to do well together with wood and various other supporting sectors and markets. So, yeah, UK equity looking very, very good as we predicted last year.
Yeah.
So both all of our UK equity funds are up month to date. Europe, it's down month to date. The funds that we hold, there's a wee bit of profit taking, a little bit of gloominess about the rollout of the vaccine not being quite as quick as many people would have envisaged. And there's areas of flare-up as well in Europe, which is causing worry. But the European Central Bank continuing with their bond purchases, putting money into the market, and they're moving along with that. Far East, looking at the Far East, well, that's actually down because of probably because of the decision by the Hong Kong exchange to increase the stamp duty. Its first increase in stamp duty for a number of years, and that's really sort of caused a bit of a downturn there. But over the 1 year period, the Far East funds that we use, they're the best performing funds within that. The Hang Seng Index lost 3%, which was its biggest fall in 9 months. The big story, I think, this month, and it follows on from what we've been saying previously, is that the credit market, which is the fixed interest market, gilts, really have taken a bit of a hammering because of fears of inflation, and this is causing the gilt yields to fall. There's also a wash. The market's at a wash with cash, so companies are realigning their debt with cheaper debt, and this is causing the price of debt to fall, not only here in the UK, but worldwide as cheap money floods the market. So anybody with a lower risking in terms of their portfolio, so defensive and cautious, over the last month or two, we've been encouraging as many people as possible just to revisit their credit rating. Yes. And to decide if they should be going up the risk scale to reduce the amount of fixed interest, which fixed interest is lower risk, but not no risk. And I think the difficulty is that the credit market has had a really great run for the last 30 years or so, and has done extremely well, but it still carries an element of risk. So we probably wanted to look to reduce the exposure to credit, because, for example, the UK gilt fund that we use, so lending money to the UK government, that fell so far this month, that fell by 10%. So for anybody who's regarding themselves as cautious or defensive, a fall of 10% is neither cautious nor defensive. Yeah. As part of the bigger portfolio, it doesn't really impact too much because we don't have we don't have any of the portfolios with 100% credit within them.
Yeah, it's definitely worth a discussion. So if you do regard yourself as a more cautious investor, then please do give us a call and we'll arrange a time to have a chat just to talk it through. It may well be that we don't make any changes, but it's worthwhile just explaining where you see things going and how we can perhaps try and offset some of that.
Smashing. And then finally, property. So there's commercial property. That's a faller over the month. Again, probably fears of tenants and being able to afford rents, and also the general move towards home working. Not as much activity within that market, and also probably the strength of sterling as well, because of the fact that that's at a new high for a number of years now. So when profits are brought back into the UK, they're not buying as many pounds as they used to a little while ago. So that's negative on the month, but nonetheless, over a wee while, it's a good holding.
Nice. So while you were just going through that there, Andrew, I was just catching up on some of the questions that we've had in. So, first of all, Tony has asked, what effect will the recent government announcements have on the markets, in your opinion?
The government, about
lockdown, I'm assuming,
about lockdown,
or potential easing and the way out of it.
Yes, so the roadmap, which hopefully will all go according to plan. So we've seen already the flood of people rushing to book their overseas holidays. So this has created a great sense of excitement amongst the stock that directly benefits from that. So anybody in the airline industry, anybody in tourism, recreation, they've seen these sectors will then come back to life. And so it gets a good boost to them in terms of short-term growth. Longer term, we still want to be avoiding as much as we can the cyclical things. So we still don't see that there's any need to hold airlines or the travel sector within the portfolio in large numbers, because once again, they are cyclical. So they do really well when times are good, and when times are less good, they don't do as well. And what we prefer to have in the portfolio are assets that perform over all time periods positively. So I think short term, those sectors will benefit bigly. Greatly. New word. That's good. Bigly. Oh, I like it. Bigly. So that was that. And I feel, well, we've seen BP and Shell both in the portfolio with big increases in their share price and demand and going forward. So it will have a good effect if it comes good. That's smashing. And the challenge will be obviously that the vaccine has to be rolled out worldwide for people going away, that it's fine being nice and safe here. But if the country you're going to, there's various restrictions and the virus is still spreading, etc., it may cause issues. So I think you want to be a little bit wary about putting all your money in EasyJet shares or Ryanair just at this moment in time.
And also I can say, Alexis, your iPad is indeed working. I've got all your messages here. So I'll give you a call and we will sort out the ISA allowance for you. And indeed, look forward to seeing you in the summer. And
you should bring in the wine.
This is not so much of a question, but worth noting.
Was Alexis asking if our wine supply was still intact?
Yes, I'll get to the shop before you arrive. And then Simon has asked, what are your opinions on cryptocurrencies after Tesla recently announced buying Bitcoin?
But then they seem to retract what they were saying on that. So there's it is an asset class that perhaps is worth considering. The only difficulty we've got with the cryptocurrencies is actually finding somehow to hold the currency within the portfolio, and it is very, very volatile. It's similar to gold in that it'll have periods where it performs exceedingly well, and everybody talks about it, and then there's periods where it performs exceedingly poorly against most other commodities. So therefore, you've got to be very, very careful when you include it, because it does increase substantially the volatility. It may increase long-term returns, but I think it's more of a specialist investment, not necessarily for a portfolio, but for perhaps to be held alongside the portfolio for those people that can accept and appreciate the level of volatility involved in it. Because when all said and done, it's still not a real thing. And until I can spend it at the Wakefield Trinity gift shop, then I'm not convinced. But it probably is here for the long term, just like the interweb. I think that's here to stay. So it is something that we consider, and including it in the portfolio, though it's just too volatile for us at the moment. But it could. There are funds out there that we do use occasionally for one or two of our investors, with regard to volatility and investment returns. It certainly can be very successful if we explain all the downsides as well as the upside.
I think that is all the questions we have today. So our next webinar, changing date slightly. We normally try and do these at the end of the month, but its next one is scheduled to take place on Friday, the 12th of March at 11:30. And Andrew has lined up a special guest star.
Guest star?
Yeah.
You can't count in the guest star. Oh.
Got to big it up. So with tax year end just round the corner, we'll be welcoming Craig Allison from Barry Scott & Co. Who's an accountant, also here in Falkirk. Craig will be here to discuss all things tax related.
So it may be an idea if you wanted to get your questions in early for this one, because Craig, as a special consideration, he's not actually going to charge you for any of the answers he gives out, which is most unusual for an accountant. So we've got to take him at that. So as many questions as you like for Craig, no charge.
And that's us for today. So thank you once again for joining us. Hope you enjoyed it. If there's any questions come off the back of what we've spoken about, please do get in touch. And as always, if there's anything else that you want to hear about, please let us know.
That's lovely. Take care, everybody. Lovely being with you.
Thank you.